AI and digital technologies are changing the M&A landscape in two fundamental ways. First, they're altering the targets we pursue. We're seeing an unprecedented interest in companies whose competitive advantage is noted in proprietary algorithms, data sets, and digital platforms. These are no longer niche opportunities, they're central to growth strategies. Second, AI is reshaping the way we conduct deals. Advanced analytics and machine learning are being deployed in the due diligence, valuation modeling, and even integration planning, enabling us to process more information at greater speed and with better predictive accuracy. For private equity, this means transactions can be executed more efficiently while uncovering risks and opportunities that might have been missed in the past. Our discussion highlighted both optimism and caution. On the optimistic side, panelists agreed that AI will continue to unlock efficiencies, creating new business models and generating cross-border opportunities, particularly in sectors such as healthcare, financial services, and industrials. On the cautious side, we debated the sustainability of valuations and whether current enthusiasm in the market borders on hype. Another point of discussion was the regulatory landscape. Governments globally are moving at different speeds on AI governance, which creates uncertainty for cross-border transactions. We came through strongly that the deal makers and balance enthusiasm with discipline, ensuring they're investing in sustainable, scalable technologies rather than chasing headlines. Investors are increasingly focused on the underlying assets of AI-driven companies. The quality of the data, the defensibility of the algorithms, and the scalability of the business model. So a key question is, does a company own its technology or data, or is it dependent on third parties? Another is, can its AI be replicated easily, or does it have a genuine moat around the technology? On the risk side, investors are scrutinizing regulatory exposure, data privacy compliance, and ethical use of AI, because these issues have material implications on enterprise value. In short, valuation today is much about accessing intangibles and risk as it is about traditional financial metrics. The biggest challenge is that traditional due diligence frameworks were not designed for proprietary AI. You can look at high-level information about the code, but how do you assess whether an algorithm will continue to perform effectively at scale, or whether it contains hidden bias? Another challenge is data provenance, determining whether a company truly has rights to use and monetize the data its algorithms depend on. Cybersecurity and IP ownership are also central concerns, particularly in cross-border contexts where legal protections vary. Increasingly, we are seeing the need for specialist technical diligence alongside legal and financial work streams to properly evaluate these assets. I see three major trends shaping the market. First, the integration of AI into core industries, from healthcare, diagnostics, to industrial automation, will create a new wave of sector-specific investment opportunities. Second, cybersecurity and data governance will become even more critical, both as a risk factor and an investment theme in their own right. And third, I believe generative AI and information of knowledge-based work will reshape not only how businesses operate, but also how deal teams themselves function, from sourcing to post-merger integration. For private equity and M&A, the takeaway is clear. Technology is no longer a vertical, it's a horizontal force that cuts across every transaction.